Today we have to talk about the massive upcoming problem for the worldwide car industry and for EV companies like NIO in particular. Now don't get me wrong, I am a big fan of the NIO stock and I think buying it right now is a solid long-term investment for many reasons, all of which you can find in my NIO 10x video linked here in the corner. However, if we're going to make an informed investment decision, we must always be aware of any threats in the market so we can assess and deal with them accordingly. In my earlier assessment, the buy advice on NIO was based on the fact that they are greatly improving the vehicle margin, resulting in a gross profit, and are strongly ramping up their total deliveries, which results in an overall profitability of the company. The analysis was also based on the preliminary results of Q4 2020 and for the month of January in 2021, which showed great improvements in production results. Now the data from these two reports suggest better than expected results in Q1, which would then pave the way for an even better Q2. Now here's where the problem comes, because this part of the business has now come under an ever-growing threat. So what is going on? Well, according to the Vice Secretary General of the China Association of Automobile Manufacturers, there has been a global shortage in the chip industry since December of 2020. The chairman also stated that this will greatly impact Q1 of 2021 and might even continue into Q2. So the chip shortage was already present in December, however it is starting to take on a greater form. According to Beijing's National New Energy Vehicle Technology Innovation Center, not at all a too long name of course. Anyways, according to them, the incorrect forecast and the factory disruptions have greatly impacted the semiconductor supply lines. The general manager of the institute, Mr. Huan, has indicated that the problems could get much worse due to the reliance upon outside technology and companies. This is compounded by massive demand for electric vehicles, which further contributes to the stress on the supply lines. In 2020, China's total car sales reached over 25 million units. For 2021, the estimate is that the sales will surpass 27 million units, putting even more stress on the current supply chain. Before we continue with the effects on the share price, please like and subscribe to the channel for more finance and banking information. So how will this affect NIO? Well, to understand how these market conditions will affect the NIO share price, we must look at the numbers. The average car has more than 100 chips embedded in the overall electronics system, and the electronics of a new car currently make up around 40% of the total cost. Now, NIO did mention in the beginning of December that they were not worried about the chip shortage and they had made the necessary preparations. However, it is not clear how large their stockpile of semiconductors truly is. Since January 2021, the chip shortage has increased and spilled over to other industries. This is driving up the price of the semiconductors even more. So even if NIO has a 4-month supply of semiconductors stockpiled, like Toyota has, they will be paying much more for the new order when supplies run out in March, and this will lower the Q2 profitability. To make matters worse, it's not just the shortage of semiconductors that is driving up the price, but precious metals in general are also rising steeply. These metals are crucial to the development of high-tech electronics. Next to this, some other car parts are rising in price as well, and when you put all of this together, it will greatly impact NIO's vehicle margin, which was finally positive and on the rise. So even if NIO manages to maintain the current growth in production levels in Q1 and Q2, these newer cars are going to have a higher per unit cost. When the Q1 earnings are lower than expected, this could cause a profit taking by early investors, lowering the share price. And if Q2 results show a deeper effect of the chip shortage, then the stock will experience a greater dip. So it will be crucial for NIO to maintain the vehicle margins and production output throughout Q1 and Q2 to avoid a stock sell-off after earnings come out. Now, from a value-based perspective, this is currently a temporary nuisance and should not affect the long-term stability and profitability of the company. However, it could lead to a massive short-term dip. Now that was it for the bad news, so what is the good news? Well, the good news is that we are now aware of the situation, so we won't be surprised if and when the share price of NIO falls. Since it's obvious that this has nothing to do with the business model or the quality of management, it does not change the long-term success of the company. From this, it follows that we don't need to change our long-term investment goals concerning the NIO stock. As a matter of fact, it presents an opportunity to investors since most likely the hedge funds are eagerly looking at the global shortage while deciding on which companies to short. NIO was already heavily shorted in the past, so it's likely that they will try to short it again and make a quick profit. So when the stock falls, you can easily pick up some more shares at a discounted value, since under normal circumstances the outlook for the company is excellent. This all means that the upcoming dip in the stock is going to be a temporary one and should not have you worried. China is already heavily investing in domestic development of semiconductors. The Ministry of Science and Technology has indicated that it wants China to produce everything in-house and at a much lower cost. This will boost the profitability of NIO even further in the next 5 to 10 years, since Beijing will be investing billions in the EV market. This was the NIO stock update. Please like and subscribe to the channel for more finance and banking information.